Welcome to this explainer. If you're focused on optimizing your financial strategies and, navigating some really complex life transitions, you are in exactly the right place. Today we're unpacking a highly specific, yet honestly frequently misunderstood, financial crossroad: gray divorce life insurance policy options. Navigating asset division during a divorce later in life can be totally overwhelming, but we're going to break down the data and your options clearly.
Okay, let's dive into this. Just to ground our conversation right off the bat, let's establish exactly what we mean. A gray divorce is a divorce or separation that happens later in life, typically around age 50 or beyond. It is a completely different landscape than a divorce in your 20s or 30s, primarily because of the decades of combined financial entanglement you have to sort through.
So, why is this such a crucial topic right now? Well, studies have shown that divorce rates for those aged 65 and older have actually tripled since 1990. Tripled! I mean, that is a dramatic demographic shift, and it creates instant gravity for the financial hurdles ahead. We're literally talking about a massive segment of the population having to untangle complex assets right on the verge of, or even during, retirement.
Here's our roadmap for today. 1. The gray divorce phenomenon. 2. Evaluating your life insurance. 3. Keeping versus replacing policies. 4. What is a life settlement? And 5. Protecting your best interests.
Section 1. The gray divorce phenomenon.
In a gray divorce, there are generally far more assets to consider. We're talking homes, retirement accounts, businesses, the whole shebang. But one asset in particular is frequently overlooked or at least deeply misunderstood. Your life insurance policy is a valuable financial asset, not just a protection vehicle. It is absolutely vital that life insurance gets brought to the table and properly valued as a critical piece of the total asset review. You can't just treat it as a background expense. Actually, scratch that. It's more like a piece of property with real, tangible financial weight.
Section 2. Evaluating your life insurance.
Now, the absolute first question you have to ask yourself is the coverage still needed? You really have to take a step back and look at your existing policy to figure out if it still serves a vital purpose in this entirely new phase of your life. So what dictates that need? Well, if your policy is intended to secure essential support obligations, it might be absolutely crucial to keep. We are talking about income protection for one of the spouses, securing alimony payments, guaranteeing pension sharing, or just standard maintenance. If your life insurance policy is the safety net for any of those obligations, you likely still need that coverage active and in force. But here is the really critical follow-up question you must ask. Is the insured still insurable? This shifts our focus directly toward the physical health of the spouses involved.
Because we're dealing with older individuals in a gray divorce, health changes are a major factor. If one spouse has experienced a decline in health and is now essentially uninsurable on the open market, that existing policy becomes incredibly valuable. It might be entirely unreplaceable. You can't just drop it and expect to get a new one later on. No way!
All right, Section 3. Keeping versus replacing policies.
If you determine the policy definitely must remain in force, keeping it requires some pretty active management. The divorce settlement must explicitly outline who owns the policy, who is obligated to pay the premiums, and who the beneficiaries are. It's a shared burden. On the flip side, replacing the policy allows you to remove all financial ties. This usually happens when ownership and beneficiary structures just become totally unworkable, and neither spouse wants a continuing link. In those cases, you might replace joint or survivorship policies with brand new, separate ones, assuming for sure that you are still insurable.
So the crucial point is this: always value your life insurance before you let it lapse, surrender it to the carrier, or make any material changes. Seriously, never just walk away from it blindly. If there's no longer an economic need or neither spouse wants to pay the premiums, you must check its fair market value first.
Which brings us to Section 4. What is a life settlement? Right before you cancel an existing policy, you've really got to wonder, does this policy have value over its cash surrender value? Especially in a gray divorce, because the insured individuals are older and might have developed some health issues, the answer is often a resounding yes.
5 times. In 2022, life settlements generated an astonishing 5 times more than the standard cash surrender value on average. To put that into perspective, imagine just handing a policy back to the insurance company for its base cash value when you could have potentially walked away with 5 times that amount to help fund your new, separate life. It's a total game changer.
So let's define exactly what mechanism creates that massive return.
A life settlement is simply the sale of an existing life insurance policy for more than the cash value and less than the death benefit. Basically, it's exchanging existing life insurance for cash today. Selling should definitely be explored when the need for coverage no longer exists or when you just need the funds for current financial needs during your divorce.
And let me tell you, institutional buyers in the secondary market are actively hunting for these assets. The most highly sought-after policies are universal life and convertible term. If you have one of these and you're older or have health issues, institutional buyers find these incredibly attractive. They are highly motivated to buy.
Finally, Section 5, protecting your best interests.
And as brilliantly illustrates the landscape out there. On one side, you have direct buyers. These are often those companies you see advertising heavily on TV. Their goal? To purchase your policy directly from you for the absolute least amount possible. On the other side, you have independent fiduciaries, like a Shar Group. A sell-side advisory firm sits on the exact same side of the table as you. Their fiduciary duty is to the policy owner, and they work to guarantee the best offer by creating a competitive policy auction among institutional buyers. It is literally the difference between taking the first lowball offer and having an advocate drive up the value for you.
Which leaves us with this final, incredibly vital question. As you navigate the complexities of a gray divorce, are you treating your life insurance like a true financial asset? Don't let an incredibly valuable asset lapse just because you want a clean break. Value it, understand your options, and seek fiduciary guidance to ensure you're protecting your financial future. Thanks so much for learning with me today. Now, go take a closer look at those policies.